Well, welcome back to Bloomberg Quint's coverage of the RBI's monetary policy. The six-member committee will be taking a decision on rates, and the overwhelming consensus is that it's going to be a 25 basis point hike. What's also going to pique the interest is the RBI governor's press conference soon after the announcement at 2:30 p.m. as he lays down RBI's stand on issues like liquidity, rupee weakness, rising crude prices, and the impact on inflation. I think I'll also be particularly interested in seeing if the Q&A that follows has some questions not just about what the RBI's stance is on inflation and rates, but also surrounding what's happening in the banking space as well.
Yeah.
So I think that'll be something to watch out for.
It's actually an extremely complex environment in which they have to come out with this policy, and whether or not they, try to look at the other peripheral aspects through the lens of inflation and growth, whether they can do that or no, is something that you need to watch out from their commentary as well.
Yeah, not in the mandate, but you never know.
Yeah.
A decision on that effect would probably have an impact on the peripheral issues as well. Joining us for the next hour or so, Jaideep Iyer, he's head of strategy at RBL Bank. Amandeep Chopra, the group president and head of fixed income at UTI AMC, and moments from now, Shubhada from Yes Bank should also be joining in with her thoughts. But Jaideep, Amandeep, thank you so much for joining in. Jaideep, let me start off with you. 40 out of 49 economists polled suggest hike. A few of them believe maybe a change in stance or change in commentary, which will be a lot more hawkish than the money markets would like. What is your stance?
Well, I think rate hike is clearly almost a given. I'm not so sure on the stance, but it might be hard for the regulator, for the RBI, to actually not change the stance with 3 consecutive hikes. So there is a distinct possibility. I think the markets are anyway factoring in anywhere between 50 to 75 basis points hike in the next 6 months. That's what short-term rates are, and I think pretty much given the complex scenario that the RBI is faced with, both internal and external, I think they would be tending towards being a little more hawkish along with the rate hike.
From an inflation perspective itself, I mean, you have got a higher risk of the imported inflation that the RBI needs to tackle. Currency depreciation, on the other hand, also poses a threat. In all these aspects, do you see them taking the change of stance related to this?
So whether the change in stance happens now or in the next policy is really the debate. I think the currency will get imported inflation along with it, but it will take some time for that to flow through. We'll have to be very keenly watching the March forecast revisions. That
actually, why I asked that was also with regards to the MSP, and that will also feed into it.
Yes, MSP and the new development being the exchange rate feeding into it, and if there is a distinct revision upwards for the CPI and the core inflation for March, I guess that would determine the policy stand. On the FX front, it's a little too early from an actual price hike coming through perspective, but clearly models will indicate where that can head. So I think there's a reasonable chance that the policy stance will also change towards being more hawkish. If not this time, then definitely next time is what I would guess.
Amandeep Chopra, Group President and Head of Fixed Income at UTI AMC with us as well. Amandeep, what's your belief? I know a lot of money market people would be hoping of the commentary not sounding too hawkish, but your view on the base stance and the commentary that might accompany the policy statement?
I think, we're not really expecting a very strong change as far as the commentary is concerned. But I would possibly say that, given the uncertainties which still sort of surround the key variables that RBI is focusing on, it is going to be a little difficult right now for RBI to abruptly change its current stance. I think given the fact that most of the data points around both oil and the currency outlook are still evolving, it may be consistent with what RBI has done in the past in actually affecting a rate hike and not change the stance, and focus more on actually giving a guidance that future steps will be more dependent on the kind of incoming data. I think the current environment, while a rate hike is clearly expected, and I would say a consensus view as far as the market is concerned, The challenge, I think, still remains that, how much more can RBI really indicate in the current environment without, influencing the tight monetary conditions which anyway exist in the domestic fixed income markets right now.
Well, that's a catch-22 for sure. But would the question mark only, Amandeep, would be that with the rupee and crude oil doing what they are doing, and as I think Jaideep and Devin are talking about, the other factors feeding into inflation, would the RBI necessarily have to sound a bit more hawkish than maybe what the money market would like? A bunch of traders that we've spoken to are saying that what's happening on the liquidity side might force the RBI's hands to do so. But if they are looking at the policy from a prism of inflation targeting, then maybe the RBI has to do that.
See, I think a word of caution as far as inflationary outlook is concerned is definitely going to be there as far as our expectations are there in the statement, monetary policy statement. But clearly, we think the liquidity issue and the decision of the MPC needs to be segregated. So the liquidity aspect is already being handled by RBI through the measures undertaken, in the recent past. The MPC, I think, will largely still focus on what is the inflation trajectory going forward, given the fact that since they met on the 1st of August and now, both currency has depreciated very sharply by almost 8%, Brent has gone up by almost 17%, and the twin effect will be clearly towards, revising the inflation guidance going forward. So I think what we will be watching out will clearly be the guidance for the H2, which earlier was given at 4.8, and the Q1 of 2019-20, which was earlier indicated at 5%, whether those are revised. So I think if they do indicate a significant revision for the Q1 of 2019-20, then I guess without changing their stance, the markets will start factoring in, another rate hike down the line.
All right, Shubhada Rao, Chief Economist at Yes Bank, also joins in right now. Shubhada, while we've all been talking about the mandate that's there with the MPC for inflation targeting, we are all very concurrent with the fact that an interest rate hike not just will bring down the depreciation of the currency, it'll help the balance of payment, but on the other hand, what it does to liquidity, which starts to become a concern, and probably balancing out the equation on that front also comes into question.
Yeah. No, quite right. I think this is the most complex of the backdrops that the Monetary Policy Committee would be meeting, because while inflation mandate, as you rightly said, is something which is a given, but the complexities get added on through the recent, credit markets developments. You have global factors which we have limited control over, namely the oil prices, the Fed tightening, and the concomitant impact on capital flows, which all in turn will have impact on the currency. Quite clearly, while rate hike in today's policy decision, we look at a 25 basis point hike along with a hawkish tone, with unambiguous language stating that they are not done and over with in terms of rate hikes. I think that is what we are anticipating today. In addition to what earlier was being discussed in terms of the liquidity concerns, while RBI has sequentially been addressing some of these through open market operations and through allowing the dip into 2%, up to 2% of SLR, but I think some additional steps also could be considered. We for one also think that an SLR cut could also be mulled over with a roadmap perhaps. Also, on the cards could be something like a recalibration of risk weights. And this is not just looking at the inflation trajectory, but overall macroeconomic stability. As I said, the complexities have arisen because it's not just the story, and the narrative is not just on growth inflation mix, but more importantly on the overall stability. Add to that the global headwinds have only gathered momentum more so since early October, both in terms of if you look at dollar index, if you look at oil prices, if you look at US bond yields, all of these have actually, created stronger headwinds for India. While India sits comfortable yet on the forex reserves, and we do not right away expect any steps in terms of the NRI kind of dispensation, but it's a classic case of a Trinity problem for the central bank. Exchange rates, they are managing through some intervention. 20 odd billion have already been spent on intervention. They have taken some measures on addressing capital flows, and a little bit on interest rate hikes that is expecting today, and likely another 25. I think October, November are the most difficult months in terms of the global turmoil impacting us.
Right, got that. Jaideep, I just want you to come in on one aspect, which is the recent, there was a RBI study which suggested a 1% appreciation in the currency leads to a 15 basis point change in inflation. A 10% rise in oil causes the headline inflation to move up by 0.6%. Keeping in mind that, globally, the view is that oil will not probably come off anytime soon, is there a possibility of the RBI to change the trajectory of inflation?
I think the trajectory of inflation is most likely to be changed, because I think they will also have to take a view on whether in their judgment basis current available data points, whether the rupee is at a new base level of 70 plus or 72 plus, or you think it is, whether they think it is, it potentially has a possibility to revert basis capital flow. So I think they will have to take that view into consideration. But given past statistical data around correlation between inflation and rupee, and since we've seen a sharp depreciation over the last month, it is very likely that they will take that into consideration and revise their expectations on inflation 6 months down the line, or March end over numbers. I think the other important point that they will be faced with is liquidity in the short term for the system. The challenge of skewed liquidity. So we have a situation where a certain set of banks, namely certain PSU banks sitting on excess liquidity, not necessarily wanting to lend, versus a set of banks potentially not as much. So system liquidity may not be a good representative of what the liquidity situation is for each of the players. So whether that needs to be addressed in some form or fashion is also critical. And it may be quite likely that we will see a flattish to inward sloping, reverse sloping yield curve for a while if they want to keep short-term liquidity tight because of currency reasons.
Okay, just a minute and a half left before the policy statement should arrive. So let me just quickly get one round of call from our experts on what do they expect, one on the policy decision and two on the change of stance. By the way, I also want to mark what the bond yields are up to right now and the currency is up to right now. The equity markets still status quo, about a 1.5% lower, but the bond yield should come up on your screen. The USD INR about 73.64, not too much. The bond yield steady as she goes, really, since the start of the trading day. These are the levels that we've been trading at, so no changes out there. Amandeep, quick thoughts. So 25 basis points hike and a change in stance, is that what you would vote for?
I think I would vote for a 25 basis point rate hike, but no change in stance presently. However, the tone is going to be somewhat more cautious.
Now, what about you?
Highlighting upside risks, yeah.
Shubhada, what about you?
Yeah, 25 basis points hike, stance would not be there, hawkish.
Okay.
Stance would not change.
Okay, we are hearing some sounds, but let it officially come about, Jaideep. But quick thoughts here. If it's an unchanged, would you be majorly surprised?
No, I think the change in stance to be hawkish is going to be a touch and go. So unlikely it will come, but the tone of the language would be clearly hawkish than as seen in the past.
Okay, we have the policy rates, the statement out. RBI has kept the key rates unchanged. So bring up the bond yields, and there should be a reaction there for sure. I don't know about the currency as much, but the bond yield should have reacted a little bit. 8.02, sharp pullback in the yields. So the bond prices have moved up. That's the 10-year treasury yield, and you can see the sharp up downtick out there. The bank Nifty too has reacted positively, I must add, 0.72% higher. Now, well, people will say that the bank Nifty was not moving for a reason the last couple of days, but yes, there is a bit of a positive reaction, flash in a pan as it may be, but a bit of a reaction on the bond yields as well. The currency might have reacted marginally, but it's a surprising decision.
Because it's interesting to say, because obviously we've been talking about how as per their mandate they've been given one indicator, which is the CPI, to work with, and CPI has been coming off, and it's been in a comfortable territory for the RBI in terms of the inflation numbers as well. So for them to keep it unchanged probably goes in line with that. And we've been talking about the peripheral aspect and how you could look at addressing all of these different problems ahead of time, which feed into inflation in different ways. But they probably are going by that number. You had a number of about 3.8, 3.9%, which was comfortably below the RBI's target for inflation. So in that sense, Jaideep, you think the RBI has pretty much stuck to it?
Well, I think clearly surprising for me, given the backdrop of macroeconomic factors. I think the potentially the role of current financial stability probably would have played an equally important role in the decision.
I guess.
We'll have to wait and watch.
Yeah, even though they probably don't look at it from that prism. But Amandeep, your initial thoughts? I think this is close to what you would have hoped for and anticipated. But initial thoughts? By the way, they've changed the stance from neutral to calibrated. So there's a change in stance for sure, but the base rates have been kept unchanged. Amandeep, your initial thoughts?
So I think this has clearly been much against my expectations. We were expecting a rate hike, but no change in stance. I think this has been the complete opposite. So they have actually retained, their current position on the rates and have changed the stance towards a calibrated tightening.
Okay.
So clearly, like I said, the broader outlook on rates does not.
Amandeep, allow me to come in here because we got Ira Dukkala, banking editor. She's at the RBI. She'll have more details. Ira.
Okay, guys, you already have the headline decision. No change in rates, but they have changed their stance to one of calibrated tightening, suggesting that they may look at further rate hikes down the line. Quick note on the voting pattern. The rate decision was taken with a vote of 5:1. Chetan Ghate voted for a rate hike. Everybody else voted for a status quo. The change in stance was also with a 5:1 vote. In that case, Ravindra Dholakia voted for a neutral stance being retained, and everybody else voted for the stance being changed to calibrated tightening. Before I go into details on growth and inflation, I want to draw everybody's attention to a proposal that the RBI has put in place for FPI debt investments. It's a proposal, and it's also a voluntary scheme. They're calling it a voluntary retention scheme for FPI investors in the debt markets. Essentially, they're saying that they will offer FPI debt investors a greater flexibility in their investments should they be willing to commit to retain a certain portion of their investments in India based on a time space of their choosing. I'm going to repeat that again. It's a voluntary retention scheme. They're telling FPI investors that we will give you greater flexibility in investment guidelines should you be willing to retain a portion of your investments in India for a time frame of your choosing. They're going to give out details of this later in the day, they've said, but I suspect that this is coming from an intention to try and reduce the volatility in the debt markets and consequently in the currency markets. And I'll let you get details and comments on that one. Going back to the rate decision, so the inflation outlook has been fairly sanguine in the sense that there's been no major change in the expectation for inflation in the second half of the year. What they have said is that there is some downside pressure being imparted on inflation from unusually low fruit price inflation, but of course upside risks continue to exist, particularly from the higher fuel prices and the weaker currency, as also the closing of the output gap, which could lead to pricing pressures coming into the economy. But they have said that they maintain a close vigil on inflation. So while they have not changed rates today, with the change in stance and their statement that they will maintain a close vigil on inflation, they seem to be suggesting that they're not taking their foot off the pedal as far as inflation control is concerned. On the growth front, they've been again said that growth is looking steady, but there are some pulls and pressures emerging on growth. Broadly speaking, they do expect growth to remain strong, although on the investment side, they said some of the global factors could start to dampen investments a bit. But I'll let your experts come in on both the fact that this is a surprise, no change policy, although there has been a change in stance, and most importantly, that interesting proposal on FPIs in debt. I don't know how the markets are going to take that.
Well, Ira, thanks for bringing us that, and let's ask somebody who would know that well before I get to Shubhada. Amandeep, come in on this. One, you were explaining your stance. By the way, as we speak, the Nifty Bank is down 0.75%. So as we said, just a brief spike and then it's come off. But Amandeep, you're explaining your stance and then the proposal by the Reserve Bank of India for the FPI investors.
So I think clearly this has been, more or less a surprise for the markets, and you've actually seen the reaction. The bond yields have rallied by 10 basis points. The currency is actually sold off, and you actually have a rupee which is just about breached 74. In my view, clearly this was not supportive of keeping rupee anchored, and the domestic rates market also in line with the inflation outlook. So clearly, the central bank feels that inflation upside risks do not exist presently, and hence they are willing to wait it out. On the other side, I guess a good part of a risk-off sentiment that exists for the EMs has also been reflected in the FPIs, pulling money out of Indian bond markets. So to some extent, to maybe assuage their concerns, RBI is giving a dispensation that as long as they commit a certain amount of their corpus staying invested in India, they will allow them some degree of flexibility in the the maturity restrictions which exist today. That, in my view, is a temporary measure, may not necessarily help much in retaining investment flows if the broader macro picture or if the sentiment for EMs continues to be weak. I think these measures are at the margin just somewhat positive, not significantly so in my view.
Shubhada, what's your take on this? Because obviously, this doesn't do much for the currency. We're now at 74 to $1 right now. Though they have been taking open market operations, they've announced a calendar for the month of October. But in the light of what they've done right now, just to keep in mind that a rate hike would have probably enticed investors to come into the bond market. It would have helped, curtail the fall of the currency. It would have sent out a slightly better signal.
Yeah. I would think so that a rate hike today perhaps would have at least calmed the markets, that RBI is on the ball and ready to raise rates. But on the action front, I think clearly the financial stability has, overruled. In addition to their relatively benign inflation trajectory, if you look at even the FY20 inflation path that they have indicated, it's 4.5 to 4.8. Now that to me is a relatively benign one, considering the fact that we have oil prices, still on the higher trajectory. We have seen the rupee impact, which will continue to play out in the economy. So given that, a much softer food inflation seems to have capped the upside path in terms of the headline CPI, in which FY20 has been given at 4.5, 4.8. In fact, we were anticipating that there could be an upside risk to the 5% inflation forecast that RBI had put out for the first quarter of the next fiscal year. We had seen a 25 basis point upside risk. Clearly, that is not to be. The stance has been changed to calibrated tightening. I think, October and November, as I was saying, were the most difficult months to come by. And that's the time a lot of global issues will play out in terms of midterm elections in the US. You will have OPEC meeting in November. But having said, a 25 basis point rate hike today perhaps could have calmed the markets a little bit. Rupee would not have been in a hurry to breach the 74. But having said, even some expectations of a 50 basis point rate hike to calm the rupee were also not likely to have calmed the rupee for too long, because there are some factors which are not directly under our control, and what's happening globally would eventually determine the rupee level. Perhaps the central bank is keeping powder dry for when a more deeper action is warranted and required. At this point, I think the headline or the key concern would have been domestic financial market stability, financial stability, and bond markets have reacted accordingly. And given the relative comfort at this point in time on inflation, has perhaps prompted the RBI to maintain a status quo today.
Okay. just get in an initial thought from Saurabh. Mukherjea is founder of Marcellus Investment Managers as well, because I must say that neither the money markets, or at least the rupee, nor the equity markets have taken this very kindly. Saurabh, your initial thoughts, because the consensus seems to be that it's a surprise. Now, some people may be happy, some people may be sad, but it's a surprise policy. No change, calibrated tightening might happen, and a proposal for some investment changes, or for encouraging FPIs to stay longer in the bond markets. Your initial thoughts here?
So look, I mean, once the RBI announced the OMO earlier this week, where around $5 billion of liquidity infusion was announced by the central bank, it was pretty clear then that the central bank was prioritizing systemic liquidity requirements over both inflation and currency protection. And that's what seems to be playing out. The RBI is more focused on protecting the financial system and on making sure the NBFCs and the CP market has enough liquidity than obsessing about inflation or the rupee. I think it's the right thing to do. The RBI has got its priorities right. But yes, it does put the rupee on an even weaker footing, and it does mean that the currency has got further to go in the coming months, even if oil stays at the current level. Even if oil stays at the current level, I think the rupee is now headed for 75 and below that, given the RBI's focus on flushing the system with liquidity and protecting the financial system rather than protecting the currency.
You would believe that? Because I know you're saying that this is a bit of a surprise on more counts, but they have anchored down inflation projections as well for the quarters ahead, and that explains in way, maybe I think the government will probably be the best person to speak about it, but kind of explains why they have probably taken this stance and changed the language for the quarters ahead.
Yeah, I think the fact that they didn't raise the policy rate is in line with their own current inflation projections having kind of come down, which probably the only reason I can think of is that it's too early to kind of judge the rupee and the behavior of the rupee over the next 6 months, and therefore the impact on inflation that may have. Within that, I think it's consistent, but I would still be of the view that it would have made markets calmer, because I think markets were expecting a 25 basis points hike. There were some odd calls of a higher rate hike as well. So I guess stability from an external perspective probably would have been better in my view. But I guess it's a very complex situation where there are too many factors, both domestic and international, playing at crossroads with each other. I think the positive part is that inflation expectations, even if you keep for a minute the rupee equation out of the way, I think the inflation outlook does look benign, and maybe that prompted them to wait and watch for a little more time.
Up until now, for the previous 2 rate hikes that the RBI took, there were, at least the kind of conversations we've been having with global brokerages and global members have been that they've applauded RBI's preemptive move in terms of what the impact on the currency would have been. So now when they have reduced inflation, their projections, the likelihood of that staying there, what do you think it's going to be like? Because crude is on a higher trajectory, that's going to feed into inflation. So we probably may not be around those levels for the RBI. So in that sense, for them to wait right now, was that a prudent step?
No, so
or they could have been a little more preemptive like they have been.
So what they've done is they've changed the stance in the sense that they're saying that the chances of a hike is now clearly, it is very unlikely that they will go down. The last 2 times when they hiked the rates, they said that the neutral policy stand means that you could go either way. I think now they're very clear that we are headed only one way. The pace is what is going to be, debated over a period of time, with, data being the guiding factor. So I think that they've made it very clear, which is one way to look at it. And I think if their own data is showing inflation to be under control, basis whatever factors are known today, I mean, it's very hard to kind of start estimating where oil will be and where rupee will be beyond a point. So I think based on whatever their information shows, if they see that inflation doesn't look like out of control, maybe that played a role, given also adding to the fact that internal concerns, as Saurabh mentioned, in terms of being there in the liquidity being available, and you don't want a systemic risk basis the system freezing up on liquidity. So I guess that would have played a role. But I personally still feel markets were expecting a higher rate, would have probably calmed the rupee a little bit. Probably would have been better, but who knows?
But on the rupee side, the OMO move that they have done, they've actually put out a calendar, which means that they are taking note of it. They're not oblivious to what's been happening. They're not letting it, probably, take its own course in a way. So they are working towards it.
Yes, absolutely. I think it is the duty of RBI to kind of manage liquidity in a meaningful way. Already there is a challenge of liquidity being skewed. So while the headline liquidity might be positive, it still doesn't necessarily mean it's equally available, given very contrasting growth and deposit attraction that is happening in the system. So I think from a liquidity standpoint, I think it's a positive, but from calming the markets from a rupee, and therefore, so this necessarily doesn't mean that short-term rates may not go up from a transactional perspective, because people will still want to go.
Jaideep, we'll have to cut across with Governor.
After 2 days of deliberations, the Monetary Policy Committee, by a 4-2 vote, decided to keep the policy repo rate unchanged, and it decided to change the stance from neutral to calibrated tightening. The MPC noted that global economic activity has held up so far, but is becoming asynchronous across economies in a highly unsettled international environment, and the outlook is overcast with downside risks. In particular, activity in emerging market economies is encountering headwinds from the oil price rise in response to robust demand in advanced economies amidst supply-side disruptions. US dollar tightening in the wake of a late-in-the-cycle fiscal stimulus in the United States. Third, growth and supply chain uncertainties due to escalating tariff wars. And four, country-specific emerging market events with attendant spillovers through portfolio rebalancing and repricing of risk channels. It is also important to recognize that close to a decade-long extraordinary accommodation by systemic central banks is finally tapering off. This inevitable normalization, coupled with the emergence of risks stated above, has resulted in several quantity and price adjustments in the global financial markets. Global trade, according to the latest data from the WTO, is losing pace, possibly on account of ongoing tariff wars. For EMEs, currency depreciations have imposed additional upside inflation risks, besides contagion risks of a technical nature from specific EME episodes and geopolitical developments. Turning to the Indian economy, the Monetary Policy Committee observed that in a sequential acceleration that started in the second quarter of 2017-18, real gross domestic product growth had surged to a recent high of 8.2% in the first quarter of 18-19 on the back of strong expansion in private consumption, investment, and exports. On the supply side, there was double-digit growth in manufacturing activity and a pickup in the pace of agricultural output, while services sector growth moderated from a high base. Kharif sowing has weathered initial monsoon setbacks and risen above last year's acreage. Early estimates have placed this year's Kharif production higher than last year's record level. Industrial production accelerated in July 2018, and the seasonally adjusted capacity utilization in the manufacturing sector has risen in the first quarter of 2018-19 to its long-term average. Forward-looking surveys reflect continuing optimism on capacity utilization in the second quarter too, as also on production, order books, and exports. However, on the other hand, the performance of the services sector in the second quarter of the year appears to have been somewhat varied. Retail inflation has eased in July and August, dragged down by a decline in food inflation and some moderation in other components, except in the fuel and light category, in which prices are closely tracking international product prices. Households reported a sharp uptick in inflation expectations 3 months ahead, although their inflation expectations a year ahead actually moderated. Manufacturing firms' expectations for both input prices and selling prices have risen in the second quarter of 2018-19. In contrast, wage growth in both rural and organized sectors remained contained. In the external sector, Exports maintained double-digit growth in July and August, which was broad-based. However, imports grew faster than exports, leading to a widening of the trade deficit over and above the expansion that had occurred in the first quarter. Higher net services earnings and private transfer receipts offset a part of the increase in the merchandise trade deficit. In the first quarter, they helped to contain the current account deficit to 2.4% of GDP from 2.5% a year ago. On the financing side, net foreign direct investment flows improved in April to July 2018. By contrast, foreign portfolio investors have been net sellers of both equity and debt on a cumulative basis. Our foreign exchange reserves at $400.5 billion at the end of September are sufficient to finance 10 months of imports. Notwithstanding the improvement in these fundamentals, the exchange rate of the rupee has experienced bouts of volatility since the MPC last met in August. In particular, India has not been immune to global spillovers from external factors we set out in the introductory remarks. The depreciation of the rupee has, however, in some respects been moderate in comparison to several other EME peers. By end September, the rupee had depreciated in nominal effective terms by 5.6% since end March. In real effective terms, the rupee's depreciation has been at 5%. The RBI's response to these unsettled conditions has been to ensure that the foreign exchange market remains liquid with no undue volatility. There is no target or band around any particular level of the exchange rate, which is determined by market forces of demand and supply. Coming to the outlook, the MPC noted that actual inflation outcomes in July and August were below the projections. Going forward, the outlook for food inflation is expected to remain benign, although the impact of the increase in minimum support prices announced in July remains uncertain to some extent as yet. However, the price of the Indian basket of crude oil increased by $10 a barrel since the MPC met in August and remains vulnerable to further upside pressures from supply disruptions due to geopolitical tensions. EME currencies have depreciated significantly and the outlook is uncertain. Moreover, as pricing power returns, there is the risk of high input costs being passed through into retail inflation. Accordingly, the trajectory for inflation is set to rise from the current level from Q4 2018-19. Excluding the HRA impact, CPI inflation is projected at 3.7% in Q2 of this financial year, 3.8 to 4.5% in the second half of 2018-19, and 4.8% in Q1 of 2019-20, with risks tilted to the upside. Should there be a fiscal slippage at the center and/or state levels, it will have a bearing on the inflation outlook, besides heightening market volatility and crowding out private sector investment. On the outlook for growth, the MPC noted that the print for the first quarter of 2018-19 was significantly higher than that which was projected. Looking ahead, it was of the view that private consumption will likely be sustained in spite of the recent rise in oil prices. Improving capacity utilization, larger FDI inflows, and increased financial resources to the corporate sector is projected to augur well for investment activity. The key risks to the outlook emanate from the tightening of global and domestic financial conditions, which could depress investment activity and the prospects for exports. Accordingly, the projection for GDP growth for 2018-19 was retained at 7.4% as in the August resolution, which means 7.4% in Q2 and 7.1 to 7.3% in the second half of 2018-19, with risks evenly balanced around this 7.4%. Reiterating its commitment to achieving the medium-term target for headline inflation of 4% on a durable basis, the committee called for a close vigil on the inflation outlook to ensure that expectations remain anchored. With global headwinds posing major risks to the growth and inflation outlook, the MPC believes the highest priority is further strengthening of the domestic macroeconomic fundamentals. It is prudent for the Indian economy to continue to recalibrate the macroeconomic stance and direction to further buttress our resilience against global headwinds. The primary responses in these areas include maintaining steadfastly inflation credibility of monetary policy, sticking to the fiscal policy targets at the general government level, which means center and states combined, allowing flexible exchange rate adjustment without undue volatility to help reorient current account balance given the revised terms of trade, retaining adequate capital and liquidity buffers in the financial sector so as to maintain financial stability, especially when retail credit growth is in excess of the nominal GDP growth. Fifth, undertaking further structural reforms to propel the domestic growth engine and liberalizing capital flows, including foreign direct investment, subject to macroprudential constraints, while also increasing the attractiveness of domestic economy to such flows. The strong growth tailwinds of the Indian economy and the Reserve Bank of India's balance sheet preparation should help smooth the short-term fluctuations, while these medium to long-term policy response, which are already being actively considered and also being pursued, take shape to buttress the economy. Finally, the well-structured institutional measures taken by the central government in the IL&FS case have been timely and appropriate. These have helped to stabilize the situation. The Reserve Bank will engage with the new management, if necessary, on assistance in its efforts going forward. I'll now request Deputy Governor Acharya.
Thank you, Governor. Good afternoon, everyone. I'll first summarize the evolution of system liquidity over the first half of this fiscal year 18-19. As you know, post demonetization, the system liquidity remained in surplus mode till March 2018. And as I've been telegraphing in the prior post-monetary policy press conferences, system liquidity has largely remained neutral for most of the first half of this fiscal. The weighted average call rate, the rate at which banks and primary dealers borrow and lend in the unsecured money market, has been 10 basis points below the policy rate, reflecting this comfortable liquidity position. Turning now to system liquidity over the past 2 months, system liquidity again remained largely neutral in August and entered into deficit zone since mid-September, as was anticipated. There was a small daily average liquidity injection by the Reserve Bank in the months of August and September. Prior to that, in June and July, Reserve Bank was on average absorbing liquidity. Nevertheless, you could see that the weighted average call rate was still about 9 basis points below the policy rate even in August and September. Several measures have been taken, especially in the second half of September, to provide adequate system liquidity. In particular, 2 open market purchases were undertaken of rupees 10,000 crores each in the second fortnight. And 36,000 crores of OMOs have been announced for this month. Reserve Bank also provided liberal infusion of liquidity through term repos in addition to what it usually provides through the frictional liquidity adjustment facilities. And there was also an increase in the facility to avail liquidity for liquidity coverage ratio, which also freed up the liquidity that banks could access, given that the collateral became eligible now for raising liquidity. And this would in turn help transmit liquidity to other sectors in the financial system and economy. The Reserve Bank will continue to proactively manage the system liquidity so as to achieve the monetary policy objective of aligning the overnight weighted average call rate with the policy rate, while also meeting economy's demand for reserve money growth. The evolving liquidity conditions will, however, continue to determine our specific choice of instruments for liquidity management. A word on events of the past few weeks in the short-term debt markets is in order. The Reserve Bank, along with the Government of India and the Securities and Exchange Board of India, have been closely monitoring the situation. I would like to encourage, in fact, urge all financial firms to place greater reliance on equity and other modes of long-term finance for funding of long-term assets, rather than relying excessively on short-term wholesale paper. Chasing lower marginal costs of funding in order to retain or acquire market share in lending is a myopic strategy. It is associated with significant rollover risks in the medium term, and this practice appears to have led to a form of maturity rat race in the financing of the financial sector. Increasing asset liability mismatch in this manner can be a particularly imprudent policy in a time of global and domestic tightening conditions. It is best to avoid this in order to safeguard financial firms' own balance sheets as well as for overall financial stability. I'll just hand it over to DG Vishwanathan, who will further speak on financial stability and NBFC sector in particular. Thank you.
Thank you, Dr. Chirag. Thank you, Governor. In the wake of anxiety about the NBFC sector, let me mention that RBI is closely monitoring the NBFC sector. The regulatory and supervisory framework for the sector hinges on three principles of protection of depositor interest when they are deposit accepting companies, then healthy customer interface, and avoiding systemic risk. The NBFC sector plays a critical role in meeting the credit needs of different segments of the economy, more so of the informal sector. The NBFC sector overall is quite strong, and the regulatory and supervisory framework is robust. We have moved towards harmonizing the regulations and have fully synchronized the NPA recognition norms for the NBFCs with the banking system now. Early this year, we had all initiated the process of weeding out many of the non-compliant small NBFCs that would have been noticed. The NBFCs have a CRAR of 15%, and they have a high density of 100% risk-weighted assets because we have not allowed the differentiated risk weights for them. So most of the assets are risk-weighted at 100%. The core investment companies, there's a separate class of NBFCs, and they are there for the purpose of making investments in the groups. So the regulatory framework for them is that 90% of their exposure should be to a group entity, of which at least 60% should be in equity. The framework for them is that they must work on a debt-equity ratio of 2.5. And this is seen at the entity level, not at the group level. Last couple of years saw rapid growth of the NBFC sector. NBFCs use diverse sources of funds for this expansion. They also tap the market. And in the process, and to keep the marginal costs, as Dr. Acharya said, some of them have resorted to increase market borrowings in the form of CP, and when that results in, that could result in asset liability mismatch, more so for companies which are financing long-term assets like infrastructure. So we are looking at strengthening. There is an ALM guideline for them, but we are looking at strengthening them so that we can avoid this rollover risk going forward. As Governor said, the measures taken by the central government in the ILFS case are timely and appropriate. These have helped stabilize the situation. We also believe that the isolated events should not be seen as having any system-wide implications. Thank you.
Thank you, DG Acharya and DG Vishwanathan. I'll take a few questions. Hindu?
Sir, since we are in an election year and yesterday we have seen some populist measure, do you think that there is a risk to fiscal deficit if such measures continue? And if there is a risk for overall financial stability since current account deficit and inflation is also going to rise, so 6 months down the line?
The government recently committed to, at least the central government, to the fiscal deficit target and moved some of its borrowing from the market to the NSSF and other small savings instruments. However, it is important that the fiscal deficit target is maintained, and not only for the reasons that you mentioned, but also to mitigate the risk of further crowding out because when the center and states borrowing program is taken together, it is of a large quantum, and therefore I assume that given that these two decisions were taken over only a few days in between, that this was possibly internalized when the government made its commitment to the fiscal deficit target and reduce its market borrowing. So far we have to take that at face value.
Thank you, Governor. Governor, many forecasters were expecting that the Reserve Bank of India would be taking some action to stabilize the rupee, because they are talking about rupee coming under further pressure because of difference with US Fed rates, oil prices going up, and current account deficit widening. The fact that you've chosen to retain the rate, is it indicative of your comfort on the exchange rate front?
Well, so let me say a few words, then I'll request Dr. Acharya to also say something on this. The mandate of the Monetary Policy Committee is a legislated one, and it is a flexible inflation targeting mandate at 4% around, with a band of plus or minus 2. To the extent that domestic and international financial conditions, including commodity prices, affect the inflation outlook and the projections, that is internalized in the projections with the fan charts, and in that respect, the risks that you mentioned are already baked in with respect to the forecasts and therefore the decision that we took today. Please do recall that prior to this we had 2 rate hikes in the space of literally 2 months, and today's stance of calibrated tightening essentially means that in this rate cycle a rate cut is off the table, and that we are not bound to increase rates at every meeting because that is not required given our inflation outlook and forecasts at this point in time. As new data comes in, we would look into changing our policies accordingly. But the calibrated tightening is the appropriate stance at this point in time, given the forecasts and the financial conditions.
Yeah, I'll just add a couple of.
Sorry.
Yeah, I'll just add 1 or 2 things to what Governor has just said. I think exchange rate is a price. Rupee dollar is a fairly deep market. It gets determined by supply and demand forces. The Reserve Bank of India's stated policy has always been to manage undue volatility rather than a very specific level. And as Governor already articulated earlier in his initial remarks, exchange rate adjustment is an important part of how your economy adjusts to terms of trade shocks. The second, I think managed float, which is what roughly the RBI stated policy is essentially what the Reserve Bank of India's foreign exchange operations pursue. And as far as interest rate is concerned, it is primarily focused, I would say exclusively focused on its mandate of flexible inflation targeting. Thank you.
Economic Times.
Thank you, Governor. So when it comes to inflation outlook, the kind of upside risks have been so quite long, right? From emerging market currencies to oil price to fiscal and everything. But at the same time, you have cut inflation forecast. What are the triggers that actually made you cut the inflation forecast and keep the rates where they are and change the stance, like instance, kind of?
No, that's a good question. In a way, the long list of risks that we have enunciated is the reason that that we have said that the risks are tilted to the upside. So that in a way is taken into account. There are 1 or 2 risks which could move in the other direction. and even the commodity prices risk is a two-way going forward, not necessarily just oil, but other commodities. The forecasts are based, and given that it is an outcome of what has taken place so far, it indicates to us that there has been a 20 basis point reduction in our projection in Q1 for 1920. So, that is something that is an outcome from the trajectory so far, and based on assumptions and the forecasts that we make from our models, and therefore the stance for that reason has been changed, because the risks are tilted to the upside, and we are focused on inflation being at the 4% level on a durable basis.
So maybe you could take one more question.
So, Financial Express.
So you've kept the rate unchanged but changed the stance. So would you call this a deferred action on the part of the central bank? Also, the currency as well as stocks have crashed after the action. So your comment on that?
Well, it is the stance is not necessarily a deferred action. It was that could be said even with the neutral stance. What this stance indicates very clearly is that going forward there are only two options in this particular rate cycle. Either we increase rates or we keep them steady. With the neutral stance, a cut was also on the table. So I think it's very clear that we are focused on the 4% inflation target on a durable basis, as RBI's long-standing policy underscored by both Dr. Acharya and I, that the monetary policy is exclusively focused on the inflation targeting, and that is the legislated mandate. Thank you.
So, the Reserve Bank press conference, answering a few questions from the media as well. Just a few initial thoughts before I get to our experts, Shubhada, Saurabh, and all of them. I think it's played as per. Okay, sorry, it's still on. Let's cut across.
My apology. Yeah.
No. To be nevertheless. Okay, fair call. He did make a significant comment on IL&FS as well, saying that pretty happy with what the government has done. But plain as per script, rupee not immune to global factors, moderated, less correction compared to peers. Lots of disruption possible on inflation, set to rise from Q4, data dependent, hence the calibrated approach. So lots of factors out there. Initial thoughts from our experts after the press conference. Shubhada, to you first. Now, they have said, I think the governor in 2 or 3 instances during the conference said that the RBI's legislated mandate is inflation defense. Do you think the asset classes, the currency and the other asset classes, are at a bit of a risk because of this, or is this a well thought out move?
I think given the oil price trajectory and the currency impact, yes, they would have impact on the core inflation, but the countering softening of food inflation is what is keeping the CPI headline inflation in a benign path or trajectory for that matter. And this is what Governor had also reiterated in the previous monetary policy interaction with analysts, that while core pressures are there, their initial and original mandate is to keep headline CPI closely anchored towards 4%. And if you look at all the trajectories, including the FY19, which they have incidentally lowered to 4.3, and as I had said earlier, the next year's trajectory somewhere around 4.5, 4.8, the headline CPI seems to be getting overall impacted by a much softer food price momentum, and that is why this relatively benign outlook as far as inflation is concerned. I think to summarize it, the last paragraph of the policy statement clearly says that all the risks point to substantial risks to growth and inflation both, and given that the external risks are heightened, it is imperative to keep the domestic macroeconomic fundamentals robust and solid, which in the very near term and context, I would mean that the macro financial stability, has also become important in the today's, context setting for policy decision. And as we progress over the next few months, RBI is, probably getting ready for a rate hike action. And that has been eloquently said in the stance that there is going to be calibrated tightening. So calibrated tightening completely rules out rate reduction. It says either pause or further hike. And given the overall factors globally, I think hike is what one would, expect going forward. But at this point, if one were to weigh the balancing act of financial market stability vis-a-vis inflation, which still looks benign, I think RBI has afforded to or preferred to wait out this particular policy and wait until the next policy review for any rate action as and how it gets warranted in terms of magnitude.
All right, Shubhada, thanks very much for joining us. Really appreciate you taking out the time. It's interesting because the governor himself highlighted that they are probably not seeing as much in terms of the MSP inflation numbers. They've not yet factored that in completion, and the external commodity prices are also something that they'll have to wait and watch. But at this point, they've maintained no change stance in rates. But Saurabh, coming to you, does this give a little bit of a silver lining to the financial sector as a whole? In terms of the liquidity pressures that they could have faced, a little bit of a lifeline for them?
I think it sounds like the RBI is getting ready to wage war. I think it sounded like a group of generals getting ready for a war. I think there's three fronts that they're fighting on, and I think the RBI was very eloquent in outlining the three fronts. The first, as they're clearly highlighting, is there is a challenge on the liquidity front. I think both the governor and the deputy governors were clear on the liquidity front, and I think they gave a pretty coded warning. They gave a pretty clear warning to wholesale funded lenders, and said pretty explicitly that if you guys carry on funding your businesses through short-term liabilities in the wholesale market, don't come crying to us 2 to 3 months out if things get worse. So coded pretty clear warning for wholesale funded lenders, and the RBI clearly saying that you've got your business models wrong, figure it out before it's too late. The second front on which I think the RBI was emphatic was that the RBI itself will keep the system flush with liquidity, but implicitly they said that we're not here to defend the currency. Our job is to protect the system, the financial system, rather than the currency. So if I was a speculator in the overseas rupee market, I think I would take a one-way bet on the rupee at that juncture. And thirdly, the RBI did say no chance of rate cuts. If anything, rates will head up, and therefore its action postponed on interest rates with systemic requirements in mind today. But I don't think interest rate hikes are too far away. So three battles to fight: inflation, the liquidity fight at home, and thirdly the need to keep the financial system together. But it sounded like a pretty determined MPC, but getting ready for battles on multiple fronts as we head into difficult times for the Indian economy.
Saurabh, what did you make of the voluntary retention scheme for foreign portfolio investors? Because while he is inviting foreign money in with perks like flexibility in guidelines, but nonetheless with a weakening currency, this is not going to be enticing to them.
Yeah, so this is par for the course for I think any emerging country. When the currency gets pulverized, the country rolls out the red carpet for foreign investors. It's par for the course for emerging markets. It's par for the course for India. I don't think too many foreign investors are going to come running to India at this juncture on the back of regulatory relaxation. And I don't think the RBI itself has any great hopes that suddenly FPIs will do a volte-face and head back into India at this juncture. But they're there to give the right signals. They're trying to indicate the right things to FPIs, that we welcome foreign capital, and to that extent we should welcome the RBI doing things like these.
Saurabh, just a quick answer before we let you go. The equity markets are not cheering this at all. 3% down now for the Sensex, 10,300 for the Nifty. More in store, you reckon?
Yeah, I think part of the challenge is it's really beyond us now. There's very little Delhi or Bombay can do, given how high the water has risen and how quickly it's risen. The Federal Reserve is banging away with rate hikes. Oil is battering us. Our own financial system, we got NBFC struggling with asset liability mismatches. So really, it's now a question of damage limitation on the part of the authorities, and anybody who's still out there holding a portfolio heavy with wholesale funded financials. I think it's really everybody's prerogative to think sensibly about their portfolios. So I think the markets still have further to fall, but in a way that'll be the least of our concerns. I think we got more important things to worry about in the coming weeks and months. The financial system is on the line here. We've got smart central bankers, determined central bankers trying to defend the financial system. But these are tough times, and we're heading for a difficult winter.
We surely are. Thanks a lot for that, Saurabh. Thanks for joining in today and giving us that perspective, Jaideep. Now, you were smiling when Viral Acharya was talking about the NBFC bank model. But that notwithstanding, I think Saurabh made an important point too, that if you just heard the commentary from the Reserve Bank of India, and if you were a trader, you would just take a one-way bet on the currency, and it's showing 74.20 now.
Yeah, I guess in the short term, obviously markets were expecting a rate hike and some support for the currency. I think they have gone out of the way to say that not really worried at this front. Maybe from a medium-term perspective, it is not showing panic. So you could look at it that way. But in the near term, yes, I think speculators would tend to or even genuine importers would tend to be biased more towards buying dollars than the other way around. I would imagine as long as it's, and one can define what is orderly and what not orderly, but as long as it's reasonable, I guess, it should be fine. Because at some level, depreciated currency also gives impetus to domestic manufacturing. It's kind of a fillip to the economy. Your exports get better over a period of time. But extreme volatility and the bearishness on that would also mean investments coming into equity and debt from foreign portfolio investors will continue to be a wait and watch.
Is there any, according to you, any significant impact on the overnight index swap rates?
I think OISs were actually indicating a potential rate hike, so I haven't seen the rates, but it should have eased up a bit.
Interesting. Amandeep, you've heard the policy statement as well. Anything that stood out for you somehow? All of us thought that this whole conversation around Viral Acharya telling NBFCs to talk about the model, etc., for me personally stood out. And the fact that they made it very clear that we are right now targeting inflation and therefore not too worried about what's happening to the currency or other asset classes at the current point of time.
I think I'll agree with both the statements. You're right. I think the priorities clearly have been, amplified in this policy statement. So clearly, markets were expecting, rates being used as one of the tools to stabilize the currency outlook. I think that clearly has not been a priority as far as the central bank is concerned. So they focus more on inflation, and hence, given the fact that they have marginally tweaked their inflation guidance downwards, has only reinforced their commitment to not hiking rates at the present meeting. Secondly, the signal for wholesale financial institutions is very loud and clear. I think this is a statement which was also made earlier by Dr. Acharya. I think he's only made it more categorical in the post-policy call, telling such entities to clearly manage their ALMs much more actively. I think the easy funding which they had relied on largely through some of the entities like mutual funds and capital markets, I think will be a lot more constrained going forwards. And you must also realize that we are heading into state elections where currency in circulation increases and liquidity seasonally does tighten a lot more. So you have both elections and the festival season of Diwali coming in, where currency in circulation increases very rapidly, and those are going to have an impact as far as liquidity in the system is concerned. So clearly, it's a warning at the right time for a lot of wholesale borrowers to manage their balance sheets a little bit more actively.
All right. Amandeep Chopra and Jaideep Iyer, both of you, thank you so very much for joining us on this special coverage of the RBI policy. I appreciate both of you sharing your thoughts with us. But it's a total lash out on the markets. Neeraj, the index is under 10,300 and falling like a rock right now, 3% down. Nifty Bank is down about 2%.
Reliance is down 7%. Second day on a trot now, and this should get people worried.
Yeah.
You don't normally see that steady name falling, but 2 days on a trot now. Reliance is down 7%. Bajaj Finance is sub 2,000. You can understand other NBFCs getting clobbered, but this is as blue chip as it gets. Maruti is sub 7,000. So it's not just restricted to the banks and NBFCs. We know the oil and gas names were down, but a lot of other large caps are down. I'm not even talking about the mid caps. I'm sure the mid caps and the small caps have fallen quite strongly as well. Just very quickly before we get to Sachidanand Uttekar, bring up the mid caps and the small caps and a bit of a vertical fall for the broader end of the spectrum as well. Sachidanand Uttekar of Trade Bulls with us. Sachidanand, can you or would you take a trade going into the weekend?
Well, if you look at the overall setup, the fall has been vertical from the levels of around 11,500 or so. And if you look at the last leg of the fall, which started at 11,040, we have seen two gaps which were very important. The first one was when the 200-day exponential moving average around 10,800 was breached. This can be termed as a breakaway gap. Today, what we saw was a runaway gap. And I think the last gap could be witnessed in the coming session, which could be an exhaustion gap. So probably in case if someone wants to carry forward their shorts, that can be possible because we may see a swing or the final leg of this particular fall getting established soon. So I think taking forward the short positions, a stop loss should be placed around 10,330 from here on, and a price expectation of around 10,140 could be immediately seen. So I think it could be, since it is the finale of this particular fall, aggressive shorts should be avoided. And probably once we see those levels on the lower side, there's a good chance that we may see a strong rebound coming up in the week forward, wherein the markets could see a V-shaped kind of a recovery.
All right. Just quickly pull up the turnover numbers. You just want to see, what that stacks up at. This week has been, we've been mowed down on the index completely. So NSE F&O about 7.5 lakh crores. NSE cash is on the higher end, about 38,000 odd crores. But we've just got about 3 minutes left to go for market closing. Interestingly, this is not the highest that we have seen, and the markets have fallen far worse than what we actually saw them dip. The last Friday when it actually fell below that 10,866 mark.
Yeah, volume certainly quite okay, and therefore in that case, Sachidanand, for somebody who's wanting to take some individual trades while you're bracing yourself for a V-shaped recovery, what are the stock-specific trades that you're recommending?
Well, at the beginning of the show, we were recommending a sell call on M&M Finance. I think the target has already been achieved. But if you look at the recent, decline that we have seen, Yes Bank still looks like a compelling sell. The level of around 205, is a good evidence that previous day's swing has been breached, and the momentum could, amplify from here on. So probably, Yes Bank. A kind of an STBT candidate for tomorrow's for carrying forward the positions. A stop loss can be placed around. Stop loss should be placed around 213, and an immediate swing towards 192 could be expected.
All right, I just want to highlight a few other stocks. And Edelweiss has lost 10%. You've got ILNFS Transport down another 10%. JSPL is at 172, which is down 10%. United Breweries is down 10%. The list is just quite long for the number of stocks that have lost closer to about 10-odd%. Engineers India is down 9%. So we've got Jet Airways down 8.5%. MRPL, Shree Infra, L&T Financial Holdings, all of these names losing anywhere between 8 to 10% apiece. Volumes on all of them have spiked up as well. And the last 1 hour of trade particularly has been quite punishing for the indices. Nifty is now down 3.1%, losing 326 points. Sensex is again down almost 1,000 points right now.
Yeah, and Diwan Housing, after the falls that it has seen, is down another 10%. By the way, I'm sure you marked it. Just wanted to point that out as well. Handful of stocks gaining, but really let's not look at the gainers. The list of losers is high and wide. Bajaj Finance is down 10% too. Sachidanand, quick thoughts here. Bajaj Finance or an Edelweiss? More downside here?
Well, Bajaj Finance, in fact, I think the major part of the fall has been done. In fact, I would not have the heart to, really go short here. But probably, with the given momentum, the stock could see a swing towards, say, 1860 odd levels, and I think another 100 points. But, that will be a good level to, get into a stock on the long side. So I would give it a pass. Probably, this is the final leg. So 1860, 65, we may see a swing there. But my intention would be, buying this stock rather than shorting here.
We've shut shop for the day for the market, so I think we should start wrapping the markets up.
Yeah, well, on close and for the day and for the week, this is not great news. 3% down for the Nifty 50. The Nifty Bank 2 has fallen 2%. Sensex about 2.7 odd percent in trade. And now let's just get in that weekly close numbers for the Nifty. 4 days of trade, remember, but I think these have been brutal in nature. I wouldn't be surprised, despite the lower volumes on the FNO side, that we see a higher FI outflow number coming in today as well. The selling that has happened in stocks like Reliance Industries and the others smacks of FI selling really. Now the last ports of call are giving way. This is, and look at that chart, that's symptomatic of what you see not in a bull market. That's the point that we're trying to make. This is the weekly performance. This is the 5-day performance really. So it's not really only for this week, also includes Friday's trade. But if you were to custom it to the last 4 days, you would see that the set of stocks would remain the same, but just that the quantum of red would be much, much higher too. Just one last point before we get in closing comments as well. Maybe Devina wants to add some names, but look at that NBFC space. It's peppered and littered with losses, bruised, battered names. Not just Bajaj, Diwan Housing down 10%, Magma FinCorp down about 9%. Non-NBFCs, Engineers India won a large order, and that stock is down about 9% as well. Jet Airways back to losing ways. Dish TV knocking on the doors of 50. Ashok Leyland, one of the most sought after auto names, or one name that almost everybody's been speaking about well, is also down about 8%. Anything got to do with rates and rate sensitives are being punished.
Yeah, surprisingly, if you were to take a look at it from last Friday's performance to this Friday's performance, the index is down 6%. So in just a matter of 1 week, it's been clobbered out of shape. On the index, 2 or 3 stocks that have ended the week in the green, and Hindalco stacks up as one of them, 4% for the week. Yes Bank, surprisingly, has gained 11% this week. Amongst the losses, double-digit losses amongst the worst performers on the index. Bajaj Finserv is down 11% this week. Bharti Airtel is down 12%. Reliance Industries is down 17% this week itself, from Friday to Friday. And not to mention, obviously, the entire oil and gas pack, with ONGC losing 17%, 34% given up by HPCL, BPCL down 30%, followed by IOC, which is down 23%.
It just look very brutal and not too great for anybody who is a long investor. 6% down for the week gone by, save for Yes Bank, all the other stocks ending in the red, and well, the likes of BPHP, IOC certainly out of whack. My final question to you, Sachidanand, and that's on Reliance Industries. The big boy is showing big chinks in its armor right now. Is there more downside here?
Well, I think the fall actually started very late in Reliance, and the way it really saw the decline from 1250 levels. I think it has reached the probable target of its 200-day exponential moving average, which is placed around 1030, and I think today's swing is somewhere close to 1038. So probably even this particular chart is indicating that there could be an exhaustion in store, and probably one should refrain from creating any fresh shorts as far as even Reliance is concerned. I think the immediate support zone for the stock lies somewhere close to 1030 and 995. So probably we may see a swing bottom getting placed in the coming week within this particular area itself.
All right. Sachidanand, we'll leave it at that. Thanks very much for joining us. Appreciate you taking out the time and speaking and sharing your views with us on those various stocks. But nonetheless, I mean, the screen is littered with stocks with double-digit losses. Time to just pack up and go home.
Yeah, well, let's do that because it's been a forgetful day of trade. But, certain losses on the rupee as well, probably weighing in the currency markets would be important too. as we shut shop.
Monday is going to be particularly important after these kind of slashes that we've seen. Most of the technical levels, at least on the downside, have been breached yet again. And like we were talking about from the futures and options side, particularly on the index, there was a heavy put build-up which lent support somewhere closer to 10,800. We're now at 10,300.
Yeah,
and in the middle, there was actually no resting place for the index. So that pretty much had a clean sweep towards the end.
Yeah, let's see how it shapes up on Monday. But important days of trade ahead. Let's wait and watch how it shapes up. But from Devin and me and the team that put this show together, thanks so much for watching the monetary policy coverage and the carnage on the markets, I might add. But stay on, because we'll try and make some sense of what's happened in the week gone by. That's coming up in just moments from now.